We are anonymous. No faces. No flags. No permission slips. Elon Musk's empire just lost hundreds of billions of dollars. But the real story isn't the crash itself. It's the terrifying truth investors are only now beginning to discover. According to financial reports, SpaceX suffered one of the largest single-day valuation losses ever recorded, wiping out roughly $400 billion in market value in a single trading session. Some estimates from financial media placed the total value erased over several days at nearly $600 billion. The numbers are staggering. They rank among the largest wealth destructions in modern market history, rivaling some of the biggest collapses previously seen in mega-cap technology companies. And here's the bigger issue. This is not just about one company. This is not just about Elon Musk. This is not just about SpaceX. This is about a global market that appears increasingly dependent on hype, leverage, and promises of future technological revolutions. When SpaceX plunged more than 16% in a single day, investors across the world suddenly started asking questions that should have been asked long ago. Why are valuations so extreme? Why are companies with uncertain future cash flows worth trillions of dollars? And how much of this market is built on expectations rather than reality? The sell-off quickly spread beyond SpaceX. Technology stocks around the world came under pressure. Semiconductor companies, AI-related firms, and high-growth stocks began falling together. Markets in Asia were hit particularly hard. South Korea experienced a severe sell-off, with major technology names dragging down the broader market. Trading volatility became so intense that market safeguards and circuit breaker mechanisms became part of the conversation again. When markets rise, everyone talks about innovation. When markets fall, everyone suddenly remembers risk. And risk is exactly what investors began seeing. For years, Elon Musk has sold investors a vision of the future: reusable rockets, satellite internet, artificial intelligence, human settlements on Mars, lunar bases, massive AI infrastructure, even concepts involving data centers in space. To believers, these are revolutionary ideas. To skeptics, they are extremely expensive dreams. The problem is that dreams eventually collide with mathematics. Reports from credit rating agencies and financial analysts have highlighted concerns about cash flow, future borrowing requirements, and enormous capital expenditures. Analysts have projected years of continued heavy spending and significant financing needs before many of these ambitious projects can generate the returns needed to justify their valuations. And that brings us to one of the most controversial questions surrounding SpaceX: debt. After raising enormous amounts of capital, the company has continued seeking additional financing. Financial reports indicated plans involving major debt issuance, with analysts discussing large future borrowing requirements as SpaceX pursues increasingly ambitious projects. Supporters argue that this is normal. They say great companies invest aggressively. They say Amazon spent years sacrificing profits. They say transformational businesses require patience. Maybe. But critics see something else. Critics see a company valued at extraordinary levels, while still asking investors and lenders for more money to fund projects that may take years, or even decades to prove themselves economically. And this debate becomes even more heated when discussing one of Musk's most controversial ideas: orbital data centers. The concept sounds futuristic. Put computing infrastructure in space, power it using solar energy, create an entirely new generation of AI infrastructure beyond Earth. It sounds like science fiction. And according to some industry leaders, it may remain science fiction. Even prominent technology investors have publicly questioned whether orbital data centers make economic sense. The founder of SoftBank, Masayoshi Son, dismissed the concept, arguing that the future AI race will likely be won through computing resources located on Earth rather than in orbit. He pointed out that electricity is only one component of data center costs. Transportation, maintenance, communication delays, and infrastructure challenges could outweigh any potential benefits. And let's be honest, even without being an aerospace engineer, most people understand the obvious question: how much would it cost to build, launch, maintain, cool, repair, and continuously upgrade massive AI infrastructure in space? The answer is probably a lot, perhaps far more than many investors want to admit. Meanwhile, behind-the-scenes cracks have begun appearing elsewhere in the financial system. Investment funds have increasingly faced liquidity concerns. Some funds have restricted withdrawals after investors demanded their money back. Private credit markets, once celebrated as endless sources of capital, are now attracting greater scrutiny. This matters because bubbles do not burst only where people are looking. At the same time, governments and institutions across the world are reassessing capital flows. Reports suggest investors are moving money between markets, while some major firms are reconsidering overseas investments and reallocating resources. Foreign selling pressure has contributed to volatility in multiple regions. The result is a feedback loop. Markets fall. Investors panic. Investors sell. Selling creates more selling, and suddenly everyone starts looking for the exit at the same time. Then there is another uncomfortable reality. While investors are being encouraged to buy into the AI future, many corporations are simultaneously discussing how AI will eliminate jobs. Think about the contradiction. Investors are told that trillions of dollars should be invested into AI because it will transform society. At the same time, workers are told that AI may replace them. So who exactly benefits? That question is becoming harder to ignore. And this is where Donald Trump enters the picture. Because while markets wobble, debt grows, and technology valuations become increasingly detached from fundamentals, Trump continues doing what Trump does best, turning every crisis into a spectacle. Instead of addressing structural economic risks, Trump prefers distractions, political theater, personal feuds, culture wars, social media outrage, anything that keeps attention away from the deeper problems. The reality is that neither Trump nor Musk created the conditions alone. But both men have become symbols of a system that increasingly rewards hype over accountability. Trump sells political fantasies. Musk sells technological fantasies. And Wall Street eagerly monetizes both. Meanwhile, ordinary investors are left holding the risk. The consequences are already becoming visible. Even Tesla continues facing regulatory scrutiny and safety investigations following serious accidents. Questions about autonomous technology, corporate responsibility, and public safety are not disappearing. They are growing louder. Investors who once ignored these concerns are beginning to pay attention. That is why this market moment matters. It is not simply a bad day for SpaceX. It is not simply a correction. It may be the beginning of something much larger. A reckoning with valuations. A reckoning with debt. A reckoning with leverage. A reckoning with the belief that charismatic billionaires can indefinitely suspend economic reality. History teaches the same lesson repeatedly. At some point, profits matter. At some point, cash flow matters. At some point, promises are not enough. No matter how many rockets launch, no matter how many AI presentations are delivered, no matter how many politicians stand in front of E3, cameras claiming everything is under control, eventually numbers win. That day may not arrive tomorrow. It may not arrive next month. But markets have a way of exposing illusions when people least expect it. We are anonymous. We are watching. Share it, subscribe, and stay informed. We are Legion. We do not forgive. We do not forget. Expect us.